So today's Cardinal lesson, we're presenting Ed Slott, America's IRA expert. And specifically, he's going to be talking about his new book that was just released. And I've read it, it's fabulous. And I really want to go to Tom, and I want Tom to talk about why are we doing this episode today.
Yeah, I mean, we're doing this episode because Hans and I are both elite advisors. Hans is actually a master elite advisor. I will soon be one of Ed Slott. And so we go to training 2 times a year. We learn all about this stuff. If you're a client of ours or you've watched our videos, you have inadvertently, you've seen us talk about a lot of the stuff we learn. We don't always reference it, but you'll notice some of the charts we'll show you in the show notes. You'll recognize those. And so we just want to introduce you to the man who teaches us all the stuff that we use in our practice. And so let me bring up the show notes. We'll get these out of the way. They're at the link below our video. They're also on our website. Again, we have the board as always. You can print it out, take notes if you want. We have a copy of Ed's book. And so this is just the front cover. We have a link to where you can purchase your copy of your own book also on the video here. And then we have some of the charts. Again, you've recognized these. We use these all the time in our practice. I have several sitting on my desk right now because I reference them all the time. But we got the tax chart, all the Secure Act rules because these are complicated, and some other things here. And so if you want more information, you can find these in the show notes. But I want to sort of turn it back to Hans, and we'll bring Ed on, and we'll just sort of get rolling here.
Yeah. So Ed, when you just take your book and you talk about the retirement savings bomb that is ticking louder, could you talk to our viewers and just tell them what you're talking about here?
Yes, I call it the retirement savings ticking tax time bomb. Say that 3 times fast, right? It's the taxes that are building up that you don't see. Kind of like you don't see termites eating away at the foundation of your home, but they're there. And if you don't do anything, at some point, everything comes crashing down. And we're at that point, I believe. We don't know for sure because nobody knows what Congress or when they're going to do something about the growing debt and deficit. I mean, the debt, I think at last I looked, it doesn't even matter. It's so many trillions. What does it matter? It's just a phone number. I used to say it was a phone number, but now it's bigger than a phone number, even with the area code and the one. I mean, I think it's 35 trillion. At some point, this whole country is living on a credit card, thanks to the mismanagement of our nation's finances through Congress. And at some point, either they'll kick the can down the road and keep building up the debt, which means it's just going to get worse, or eventually, and maybe sooner than later, they're going to come to their senses. I know that sounds crazy, Congress and sense. How do you even say that in the same sentence? But and maybe they're going to start searching for revenue to start managing this national debt. Well, if they do that, and it may happen soon, and if they do nothing, it will still happen in 2026 when all the tax cuts from the Tax Cuts and Jobs Act expire. So the ticking tax time bomb is the tax building up like termites, eating away at your IRA and your 401k. Why those accounts? Because those are tax deferred, not tax free. That's a big, big difference. That money has not yet been taxed. So it's the low hanging fruit for Congress. I call it a big, juicy steak. When they need money, that's where they're going to go and take a bite out of your retirement savings. You can do something about it now before that ticking tax time bomb goes off and leaves you high and dry for retirement. It's just a matter of when, not if. It's going to happen. Remember, all of this money will be taxed, not if, but when. Kind of like death, sorry to say, not if, but when. It's going to happen. So why not prepare now while you have 2 great things in your favor? Low tax rates and great advisors to help you through it, like Hans and Tom here, been studying with our group on the tax planning, exactly what you need to know. Most advisors don't have this specialized knowledge, and every day it seems to get more and more complicated. IRS just created new rules for required minimum distributions. There are so many band-aids on this law that you can't even do this yourself anymore. You really need experts, specialists. That's why Hans and Tom and our other members around the country of our elite advisor group study this full time. We're not talking about one seminar or somebody on, on a Zoom call or something while they're eating lunch. We're talking about guys that are committed, like these two and our other members, to the tax planning. The tax planning, managing the taxes. When it comes to retirement, there's two parts. You manage the investments on the way in, but you got to manage the taxes on the way out, because it doesn't matter. I don't care if you have an advisor that says, oh, I made you 30% a year for 30 years. Hasn't been done in the history of the world. Who cares if you lose it all on the way out? All you did is build a savings account for the government. You don't want that. I say this in every seminar, Hans. You probably heard me. You want your plan, not the government plan. I just did a seminar the other day. I forget where I was already. I can't even. Oh, down in Miami I was. Yeah. And how could I forget? I ended up sleeping in the airport there because of all the weather issues we had recently. That hasn't happened in a while. But every time I say you want your plan, not the government plan, there's somebody in the group that asks, it's a bunch of consumers like everybody watching here, worried about their retirement savings. Will it be there when they need it? And they say, every time you say your plan, not the government plan, you never tell us what the government plan is. And some people might say, I'd like to know what the government plan is. Maybe I'm interested. No, you're not interested in that plan. But if you must know what it is, it's very simple. Do absolutely nothing and let the government take your money as they please under their laws. You have the ability to control your tax rates now. Look at the low rates we have. I know Hans had a chart on that. I mean, if you're not taking advantage of these rates, you're leaving so much money on the table. And that's why I wrote this book. That's why it's a ticking tax time bomb. But the solution, that's the problem. The solution is get this money out while taxes are on sale.
And I think that brings up a really good point that I just want to hammer home is a lot of people, they view this account, they see this balance growing their whole life. They have put money in the 401k, they're stuffing it in there, and it's grown to maybe over $1 million, $2 million, and they feel really proud about that. But that is not all your money, right? Part of that money is owed back to the IRS, or if you're in a state that has state taxes. And so I think there's a mindset shift that has to happen for the clients, for you, to know that that account balance is not all yours. Someone is going to pay taxes. Either it's you or your kids when you leave it to them. And so I think it's smart to have a plan of how to get that money out.
Yeah, I always say your IRA is an IOU to the IRS. And what you said, Tom, I don't really have much client work anymore, but I did years ago as a practicing tax accountant, a CPA. And exactly what you said happened to me several times. But I remember this one guy many years ago. He came in, just like you said, Tom. He was so proud. He came in with his IRA statement. He said, look, I hit $1 million. I got $1 million in my IRA. He was so happy, a regular working guy, just overtime. And I said to him, all right, calm down. Let me see the statement. Yeah, this is not yours. This is just temporarily on your letterhead. You're not keeping most of this. Do you understand that? We've got to do something about it. So exactly what you said, Tom. It's very easy to get lulled into a secure retirement feeling because you're looking at your statements thinking that's your money. Not if it's tax deferred. Tax free, a different story, like Roth IRAs. You look at a Roth IRA statement, that is your money. That's why I love Roth IRAs. I love anything that's tax free.
Yeah, Ed, could you tell our viewers and listeners just a little bit about the Elite Advisors Group and what's involved in being one of those?
Yeah, it's not for most advisors. In fact, most advisors, I would say, most people don't want to hear this, but 99% of the advisors out there, financial advisors, including CPAs even, who are supposedly tax guys, don't have the knowledge you need them to have when you're pulling this money out. So you might be watching this video on YouTube, right? You're saying, Ed, 99%. Come on, is that really true? 99% of advisors don't know this? Yes, I exaggerated. Are you telling me only 1% of advisors know anything about this? Yes, I exaggerated. It's not 1%. It's much less. It's much worse. It's much worse. And we know this because we've trained more advisors in this specific area than anyone in the country through our company. And we created over 20 years ago the Elite IRA Advisor Group, Ed Slott's Elite IRA Advisor Group, that started 20 years ago because advisors like Hans and Tom said, we want to do better for our clients. Yes, we can do investments. We can help people make money, even manage money, but we want to help them keep it. With IRAs and 401ks, retirement accounts, it's what you keep that counts. So I created this group, started small as an advanced study group for advisors that were serious about the tax planning, helping people you can actually make a lot more in the tax planning than you'll ever make in the market with more guarantees and more certainty. So over time, the 20 years, this group grew to about 500 members. That's why I say only 1%. I don't know how many advisors, if you count all financial planners and CPAs, probably over 1 million people. So if yours is one of them, wouldn't you want to hope that they're a part of this group, that they have this knowledge? They don't. It's a big commitment in time and money and training. Remember, this is a membership group where people like Hans and Tom are getting updated all the time, are getting educated continuously, not just in the big workshops we hold, but the minute anything changes. I'll give you an example. When IRS came out with new RMD, required minimum distribution rules, we had that out to our group, people like Hans and Tom, within an hour of when it happened. And we, and there's a piece we just said to the group on the changes in the rules that affect everyone with a retirement account. You might say, I didn't hear about that. Well, because you don't have an advisor that's up on these things, or I didn't know this. And here's the problem with having an advisor that doesn't know. The big problem is, and I'm not saying they're bad people. They just don't specialize in this area. Most advisors are trained to help you make money, but if they're touching IRA money, they also have the obligation to help you keep it. Most are not trained on that. It's not that they don't know. What makes them dangerous is they don't know that they don't know. They don't even know to ask. And that's why I created this group of specialized advisors who make a commitment to learning about the tax planning, getting that money out. It's like the average advisor, if they were a mountain climber, they'd only know to get to the top of Mount Everest, but they wouldn't know how to get down because they have no exit plan. That's what we specialize in, and that's what we train advisors like Hans and Tom here to make sure their clients are up to the minute, because this stuff is changing. It's so fluid. And it's really, actually, to me, it's a crime that it's this complicated now to take your money, your own money, out of your IRA and your 401k. Why should this be so complex? So there's two parts to this that I believe are unfair. The rules are some of the tax rules are some of the most complex in the entire tax code. And add to that, what makes them even worse is that many of these things are irrevocable, unchangeable, permanent. You don't get a lot of second chances. Many of these things, there's no do-overs. You got to get it right the first time. We've seen people who lost literally over $1 million of retirement savings because they didn't know how to do a rollover the right way. We just covered that in one of our last training sessions. We covered some of these cases. That's what we do. People say, why do you cover so many cases and rulings? Well, the reason is there's a saying, learn from your mistakes. I think that's a dumb saying. I'd rather have you learn from other people's mistakes. Your mistakes are too costly. So that's part of the training we do. As you know, Hans and Tom, we have a whole section every meeting about major cases that come up where people literally lost a lifetime of savings because they didn't have the right advisors. They didn't know the rules. They weren't informed by their accountant, their attorney, their financial advisor, who didn't have this specialized knowledge. So I believe, and that's why I started the group. We're an educational company. We started the tax training group 20 years ago, that anybody with an IRA has to have an advisor that's invested in their education. If your advisor isn't invested in the education, you shouldn't be investing with them, because then your retirement savings are at risk. And that's why we started the group. And that's why many of our members, like Hans, have been members for, more than 10, 15 years, some of them 20 years. Because they know this is changing. This is not a one and done. You need advisors that keep up with their education.
Yeah, I want to touch real quick on the Secure Act and the Secure Act 2.0 and the 10-year rule. Just you've touched on it a little bit, but specifically talking about it.
Yes. Well, the Secure Act, let me tell everybody about the Secure Act. I've been studying tax law for 40 years, and I notice one constant that has never changed. Whenever Congress names a tax act, you can almost always bet that whatever they name it, it will do exactly the opposite. So how about that Deficit Reduction Act years ago? How's that working out, right? Or the Tax Reconciliation, none of these things ever did what they said they were going to do. So when I saw the word Secure Act, I said to myself, hold on to your wallets. And sure enough, it was a revenue grab. What does that mean to you? More of your money, either in your life or, as Hans said earlier, or to your beneficiary's lifetime, will be consumed in taxes. That's the money you were counting on for retirement or as a legacy for your beneficiaries. So they took away, they being Congress, they didn't like the idea of something called the stretch IRA, which we all love. And a lot of people planned on. That was the rules. Those were the rules for 20 years. What that was the ability for you to leave your IRA to anybody you wanted, children, grandchildren, which you can still do. But if they could stretch or extend distributions over their lifetimes, over 30, 40, 50, 70 years if there was a 10-year-old beneficiary. That's all gone. Congress didn't like that. They didn't want to wait that long for revenue. They said, basically, we believe retirement accounts are for the people who earned it and their spouses, and not as a wealth transfer or estate planning vehicle for their beneficiaries. So they killed it. Well, that changed everything. They replaced it with a 10-year rule, which means essentially when your beneficiaries inherit, all of that money has to come out by the end of the 10th year after death. Well, nobody planned for that. Now we have these big growing retirement savings in IRAs, 401ks, all taxable, and they're all going to be pushed into a shorter window of taxation. The shorter you make the period where all of this money has to come out, the more of that will be consumed in taxes. So you have to do something about it. Now, Congress created the act. IRS just created the rules, and they made them even more complicated with the 10-year rule and RMDs they made it so complicated. That's why you need people like Hans and Tom. This is not do-it-yourself material anymore. You can read about it, and it's good you read about it in books like mine, but you actually may only have one chance to get this right. You really need experts when your life savings are on the line.
Yeah.
I want to hit on that a little bit more too, because a lot of people, their default plan is this balance is what they're leaving as a legacy, right? They maybe have not thought through that very clearly.
Yeah, they what you said, Tom, the only reason I cut in, they are leaving a legacy, but to their Uncle Sam, not to their kids.
I mean, exactly. It's like the IRA or 401k is never intended to be a legacy goal. And if that's the money you're planning on leaving to somebody else, you need to really think through that, because like Ed just said, a lot of that is going to go to taxes. And especially with the Secure Act change, where now they have a 10-year window to distribute it. And most kids take it out in the first time they get the money, they take it out in a single year anyways and pay a whole bunch of taxes on the way out. So that's not a good way to leave money to the next generation.
Yeah, in New York, we call that a smash and grab. Yeah, even with the 10-year rule, you're right, Tom, exactly right. People say, well, I can't stretch. And I talked about this for 20, 30 years, the stretch IRA, but rarely did I ever see, especially a younger beneficiary, 30s, 40s, 50s, sit there with a pile of money, 500,000, $1 million, and he was told, or she was told, you have to take at least 3% out or 4%. That never happened. Well, all of a sudden, I could buy a house, I can go on vacation, I could do this. Give me the money. Well, you have to pay tax. Give me the money. So you got to change that mentality. And remember, the beneficiaries themselves may be in their own highest earnings years when they inherit, leaving more to the IRS. So what Congress did, they woke us all up. Maybe they're saying when one door shuts, another door opens, all of that. maybe they did us a favor and said, look, we're going to make IRAs a horrible asset to leave to your beneficiaries. That's one of the few things Congress succeeded at. They made this a horrible asset. So the plan is to change what you leave to your children and grandchildren. One of the ways you can do that is leave them a Roth IRA. That too has to come out in 10 years, but at least it's all income tax free and you're taking advantage of today's low rates. Things like permanent life insurance, anything tax free. And that's what I cover in my book. I have chapters on each of those. So what Congress really did, maybe they did us a favor. Maybe they incentivized us to do the better planning we should have been doing all along, moving from tax deferred to tax-free vehicles, or what I like to say, moving from accounts that are forever taxed to accounts that are never taxed. To me, that's the holy grail, tax-free retirement. That's the promised land. That's where you want to get to.
So it can be clear what you're talking about is two things: Roth conversions and Roth IRAs, which don't have minimum distributions, and they're going to pass tax-free to the next generation. And then you're also talking about purchasing life insurance, and which is going to pass tax-free
and the
to
things
the
I'm
next
saying,
generation.
Right, exactly. But I'm not saying everything I'm saying is for everybody. Of course, that's not true. That's why you need to discuss this with advisors. Like you see how Hans and Tom have this all laid out. That's why you need to be educated, but find out what's best for your specific situation from an advisor that has access to this knowledge, like Hans and Tom. And that goes back to the Elite IRA Advisor Group. That's why we created it, to create a team of people that are familiar with the tax rules. And they're not going to know everything either, but that's why they have us. That's one thing, Hans, I left out when I talked about the Elite Advisor Group. The single biggest benefit, access to me and our team of experts. Because the difference between the advisor I talked about before, that, remember I said they don't even know that they don't know what to ask. The difference is you want an advisor that knows what they don't know, so they know to ask. And being a member of our group, they have us essentially as a back office. I'm sure you have both called some of our experts from time to time, but at least you knew, your antennas went up. You said, you know what, I think there's something here. Let's hear from the experts. Have you gone to I'm sure you have from time to time.
We call them all the time. I mean, we call them regularly. I can think of somebody, they have a special needs child. We're setting up a special needs trust. They got IRA money. They got Roth IRA money. And boy, did we need those folks. I mean, we were constantly going back and forth, and got the attorneys involved, actually going through us to talk to your people, many of them are attorneys, and then asking a question and getting some direction back through us to the attorney.
Right. So that's the real advantage you have over most other advisors. Most other advisors don't have that ability. And I know that, as I said before, I train many of them. And they tell me they go back to their institutions, their big financial companies. They try and get somebody on the phone. It takes 3 weeks for an answer, and the answer's wrong anyway. You can't rely on that. Remember, you have one chance. So that's one of the big benefits to working with one of our trained advisors, that they don't know everything, but they know who to call, because that's all we do. And as you said, you call them and they're always available. It's almost like they're there 24/7, right?
They answer the phone. I mean, they really do. And they know who I am. They know who Tom is. Because we meet them at the 2 seminars we go to.
Isn't that impressive?
And they're speaking
when you're talking to clients and you say, hold on, I'm not sure, but let me check with the Slott team.
We do. We use it all the time. Could you talk a little bit about QCDs?
Oh, I love QCDs.
And then we can share how we use them in our
I love QCDs. Why? Because I love anything that comes out of an IRA tax-free. I'm all about tax-free. And it's very simple. If it's tax-free, you keep more of your money. Tax-free is always better. So if you're charitably inclined, and that's what a QCD is, qualified charitable distribution. And the reason I say it's only if you are truly charitably inclined. I'm not one of those advisors, and some of my CPA colleagues disagree with me on this. They like to do charitable planning, even for people who are not charitably inclined, just for the tax benefits. I don't believe in that, because if that was the case, if you just want the tax benefits, just give all your money to charity, then you'll never have any tax. Nobody's going to do that. And I've seen experiences where people tried to do that, and they got all upset at the end when somebody told them, you actually have to give the property away. Well, I don't want to do that. So you have to be charitably inclined. In other words, if you're giving 5 or 10,000 or 3,000, whatever your number is, to charity, you're giving it away anyway. Let's just change the method. If you qualify for QCDs, that's the only roadblock or downside, I might say, to QCDs. Not as many people qualify, not enough, that I think, because the rules say you have to be an IRA owner or beneficiary, but you must be 70 and a half years or older, 70 and a half years old or older. And so it's only available to that group of older people. But if you're an IRA owner who's 70 and a half or older, you give to charity anyway, you can do a direct transfer from your IRA to the charity. And when that comes out of your IRA, it's absolutely tax-free. Plus, if you're subject to RMDs, which start at age 73, a different age, that transfer, that QCD, qualified charitable distribution, can satisfy your RMD up to the amount. So in a simple example, let's say you give $5,000 a year to your alma mater, all right? Maybe that's for you guys, Duke or UNC, right, in that area. I'm not excluding other people, just happen to know where these guys are. So let's say you want to give 5,000 to Duke, because they may need help now that Coach K's not there anymore, So you want to give 5,000 over there. And normally people write a check. Don't do that anymore. If you have an IRA and you're 70 and a half years old or older, transfer from your IRA. And let's say, just to make the example easy, you're 75 years old and your RMD, the amount you must take out, is also 5,000. You don't even have to take that, because the transfer you made to charity satisfied that RMD. This is a great deal. And you got the money out for 0% tax rate. It's one of the best provisions ever created. It will always save you money.
And on that same idea, I also want to point out that the same is true for leaving money upon your passing, right? If you want to leave money to a charity, IRA money is perfect to leave that, and leave the other money to your kids or whoever that might be. I mean, Hans, your mother-in-law sort of did the opposite of this, right? I mean, this was years ago, but she left the IRA to the kids and the cash to the church, right? And it's just not, from a tax standpoint, it was not the most efficient.
That's exactly what she did. And so we got this IRA distribution. We had some other money too, but I was just part of the whole thing, and I'm just looking at that, and it would have been a lot smarter to reverse that, is to give the IRA money to the church.
That's right. See, these guys are students. That's in every one of our manuals. Yeah. Reverse the bequests. Because many people, if you're watching this and you say, I had this good feeling, I wanted to leave this to a hospital or a doctor or, a university or some other charity, religious, whatever, and they put in their will, I leave $10,000 to the YMCA or whatever, right? Don't do that. If you have an IRA, leave them the IRA. They don't pay tax. Now your beneficiaries get better money that gets a step up in basis. IRAs never get that. IRAs are lousy assets to leave to anybody but a charity.
Yeah. So could you just talk a little bit about Medicare IRMA? I mean, just how that factors.
Oh, okay. I'll talk about that. But I think everybody knows when they see it coming out that this is a big hit, the Parts B and D premiums. And there's also a cliff. So if you go $1 over the income limits, and you could look at the income limits, I know you have the black chart we give you there, the black and gray chart. So if you go over those income limits, it goes up. So one of the strategies you can do is do a Roth conversion before you start Social Security. But this is a little tricky. The IRMA charges are a sneaky kind of tax for two reasons. Number one, it doesn't show up on your tax return. There's not a line IRMA charges. It's off the tax return. It comes out of your Social Security, or you pay it separately. The other reason is it's hard to plan for because there's a 2-year look back rule. So when I said get rid of bring your income down before you start Medicare, people think, oh, I'll do it before 65. That's not good enough. You have to do it before you're 63, 2 years earlier. So you might do a Roth conversion, do more Roth conversions before you turn 63, lowering what eventually will be your RMDs. But even if you're already taking RMDs, because I had a woman at the one of my seminars once, and I was talking all about Roths because I love Roth, because I love tax-free, because I love keeping more of my hard-earned money. That's just a given. And she says, I love your idea. And she was already taking RMDs of converting to a Roth. And I said, yeah, it's a little tougher once you're taking RMDs because the RMD itself cannot be converted. So you first have to satisfy that. And then you can convert the rest. She says, okay, I could do that. But if I convert, won't that add to my income? I said, yes, you pay tax on that. Well, she said, well, if I do that, is it possible my Medicare IRMA, income related monthly adjustment amount, my IRMA charges will increase? I said, yes, that could happen. She says, well, if that happened, that would make me angry. I said, so here's what you should do. If that would make you angry, convert anyway, because I'd rather have you be angry for 1 year than be angry for the rest of your life. Because if you don't do it, the RMDs are going to keep coming, and this will be a problem every year.
Yeah. Well, let me tell you about another situation where you talked about converting before 63. If somebody's retiring, retirement or work stoppage qualifies for an IRMA appeal. So we've run into this. A lot of people come to us at 65, they're going on Medicare, and they're doing all their financial planning with us. And then we come up to Roth conversions, and you're right, it's going to create a problem for 1 year in the future. But if your retirement is between now and that time, we can do the conversion, run up the tax rate, get the thing to tax free, and then we can appeal the IRMA once.
Yeah, you can only appeal it though based on the income, that you don't have your W-2 anymore. Not the Roth conversion part. You won't get that because if you say my income spiked because of a Roth conversion, they're not going to allow that as an aberration, as a spike. But
you're absolutely right. But we're going to plan the year after retirement to be a really low income year, or right under the IRMA threshold.
Yeah, it's on the wages. So if you have we're making 150,000 and now you're making nothing, you have a right to appeal, and you'll probably get that.
Yeah, I mean, we do this all the time for people, and it's
See, that's another great thing that I don't know if a lot of advisors are doing that for their clients.
Yeah, well, we're in the Medicare business in a very large way. We have over 5,000 Medicare clients paying us premiums monthly, and so we're doing financial planning for some of them. But the new people coming in are turning 65, a lot of them, and so that Medicare is the draw. And then we're covering all 7 worries with them. So,
yeah, I see that on the board. It's great.
Yeah, Tom, can you look through the list and just see if it looks to me like we've touched on everything that we wanted Ed to touch on for our clients.
Yeah, I think so. The one thing maybe we'd spend a little, just not a long time, but a little bit more on there is just what happens if you have a couple when the first spouse passes away, what the impact is for the surviving spouse. And that's another reason to do some Roth conversions now to make their life better, when eventually one of you passes away.
Yeah, I cover that actually in my book, as you see, the widow's penalty, I call it. And we've covered that in our training, so I know you guys are on top of that. But here's the problem. I call it the widow's tax penalty, or the widow's penalty, because most people leave everything to their spouse, which they should. I mean, that's normal. That's what most people want to do, and that's fine. But the problem is the tax rates. If you leave everything, let's say the husband dies, he leaves everything to his wife. Other than maybe a small adjustment in Social Security, she's going to have the same income they had together. because she's got everything now, except now her rates will be jacked up at single rates. So you want to plan ahead for that. That may be another reason to do a Roth conversion. And I don't want to end on a morbid thing, but if you're watching this and a spouse has passed away this year, this would be the year to do a Roth conversion, because next year, this would be the last year you get generally to file a joint tax return and get the break of the joint rates. Next year, you'll file as single, and a Roth conversion will cost you a fortune. You get hit both ways. If you convert at single rates, cost you a fortune. If you don't convert, you'll have a fortune in tax to pay in RMDs. So you get hit both ways. That's the widow's penalty. But that's another reason to plan out a series of Roth conversions. And we've been talking about Roth conversions, and I'm sure you've covered this on every show. When I say that, I don't mean take the boatload all at one shot. Some people like to, because I had several clients over the years that converted everything because they just hated RMDs. They didn't want to bother with it, and they converted everything. And now they're pretty happy about it. But probably the best plan is to do a series of smaller annual conversions over time, sort of like dollar cost averaging into the market, into the tax rates, like you would do with the market, and get the benefit of the low tax brackets each year. So over time, you're taking down this taxable IRA and building up on the tax-free side.
Ed, I can't begin to tell you how awesome this is for you to be able to talk directly to our clients and people that are thinking about becoming clients. We talk to them about you and the advisors group all the time. And your charts are in the show notes of many of our shows, because you cover a lot more than IRAs and taxes.
Yeah.
And so we put these charts in all of these. We talk to them about you all the time. So it's just awesome to have you on here.
Well, now I'm talking to them about you and getting a trained advisor. If you want to hold on to your retirement savings, not only hold on to it, but make them grow where you keep more of your money into tax-free territory. Get your plan, not the government plan. Move your money from forever tax to never tax. You and your beneficiaries will always have more and keep more and pass it on.
Well, that's awesome. I'm Hans Scheil.
And I'm Tom Griffith.
And I'm Ed Slott.
Yeah, that's awesome. And we thank you very much for listening. Bye.
Thank you.
All right. Thanks, guys.